The Consumer Price Index, which measures inflation on the consumer level, was actually released yesterday, and it showed that inflation increased 0.1% from April to May. And over the last 12 months, inflation has lowered to 4% year over year compared to last month's reading of 4.93%. However, we still had a rough day when it came to interest rates. This in and of itself is confusing and really shows the volatility of the bond market currently. Usually, if we see inflation coming down, mortgage rates typically follow behind, but yesterday wasn't the case. The big reason behind that could be the core portion of the inflation report that strips out food and energy prices because of how volatile they can be month by month. And that went from 5.5% to 5.3% year over year. And this was higher than what they expected, primarily because of shelter costs. If shelter was removed from consumer price index, we'd be at 2% year over year. This is how heavily shelter costs are weighing on inflation, but it's not what you think. Shelter costs lag heavily because leases are on a 12-month term, and not every lease expires at the same time. The spike of rents started around this time last year, so the expectation is that shelter costs will come down significantly in the coming months, and that should get inflation much lower. But at this point, we can't say with certainty that that will cause mortgage rates and bonds to react well because they didn't seem to react well this month. We just have to keep keeping an eye.